The big macroeconomic trigger this afternoon or this evening will come from the GDP data. As we said at the start of the show, important data, not just because it's GDP, but because we're trying to see what's happened to the economy after 2 quarters of very weak growth. Sonal Varma of Nomura is joining us from Singapore to help us understand what we should look for and what she's looking for. Sonal, very good morning to you. Thanks so much for coming in. Just let me start with the basics. What are you expecting to see in the number, both headline and also within that, what are you watching for?
Yeah, hi. I mean, our broad expectation is that the numbers should pick up, so giving a clear signal that the economy bottomed out in the June quarter, and the drags because of demonetization and also because of GST are fading off. So that's broadly what we're expecting. In terms of the numbers, we're looking for GVA growth to pick up to 6.3. That's up from 5.6. And GDP growth to also pick up to about 6.2 from 5.7. The composition of growth, of course, will be quite important. This particular quarter, we've seen lower agriculture production for the summer. So we're expecting agriculture to slow down. But there's sort of more than offset by two things. One is restocking ahead, after GST, which will benefit the manufacturing sector. And remonetization, of course, continues. So that should be positive for a lot of private services like construction, trade, transportation. So more of private sector driven recovery is what we are expecting. I think one thing to also watch out for will be government spending, because that has been a big contributor to growth in the last 3-4 quarters. We are expecting that to actually be significantly less of a contributor to growth this time around.
Sonal, just picking up on specifics now. So on manufacturing, for instance, we've all been talking about GST. We still don't know how things have settled, have not settled. But I don't even know whether the parts that have not settled would reflect in the data, because that may still be in the informal sector. What would your sort of understanding be of manufacturing activity right now, both from the GDP numbers that we see, but also from your own indicators?
Right. So, I mean, when we try to assess manufacturing sector, there are a couple of things we look at. One is, of course, the manufacturing production numbers, and that has definitely picked up in the, in the September quarter versus the previous quarter. And second is to look at, how corporates in the manufacturing sector in general have done this quarter in terms of their sales and profitability. And those numbers are also much better. So the indicators do suggest that the manufacturing sector should recover in the September quarter. But like you said, there are obviously some sectors, the small and medium enterprises, the SMEs, particularly in the exporting sector, which are still feeling some of the negative effects because of GST. So it's not all clear as far as GST negative effects are concerned, but for the September quarter, we do expect a better number compared to the June quarter.
And on construction and financial services, just to close the sectoral loop, what we saw due to demonetization should essentially play out by this quarter, right?
Well, I think, those two are, of course, separate stories altogether. I think construction is heavily unorganized and was extremely cash-oriented sector, and one of the sectors that did get significantly hit after demonetization. Most of those negative effects are now, getting over, and some of the construction sector indicators like steel, cement, etc. have done well. So we do expect construction to register a decent bounce. The banking, the financial sector, real estate sector could be a bit more mixed. We have started to, in the last couple of months, see a pickup in credit growth. So credit growth is up from 4% to now 8.5%. But we've also simultaneously seen deposit growth moderate. So I think, from a 2-3 quarter perspective, the financial sector should recover. But particularly for the reading that's coming out today, it might be more flat.
Okay, Sonal, just talk a little bit more about the government aspect of this, both what comes in through the government consumption side, also through, segments like public administration, etc. What is your sense of how government finances are shaping up? We've been talking about it. We all think that there's a problem, but, nobody really knows what the GST numbers look like, how they'll play out from here. What's your understanding?
Well, I think, we're all trying to grapple with how this plays out. We do have, the monthly numbers in terms of the collections, and, but there are a few uncertainties. One in terms of, what is the amount of input tax credit that did not get claimed in the initial months, which will actually show up in the coming months. And October obviously was the first month where we did see a moderation in the net GST tax collection, so we might see more of that. Second is, the big reduction in GST rates we've seen at the November meeting, of course, is going to have some negative effect on revenue collection going forward. Third, obviously, is this entire, export refund. What is the amount that is still sort of pending that needs to be given back? So I think, given those issues, it appears at the outset that there could be a cash flow problem for this financial year on account of GST. But I think, it's more of a cash flow problem. If we sort of look out more into FY19, I think we should see the positive revenue effects of GST, because the number of businesses registered under GST is now 95 lakh, and as the year progresses, the compliance is going to increase. So I think the risks we are seeing on account of GST is more because of the initial teething issues, is a cash flow problem perhaps for this financial year, but I don't see this as a medium-term risk. I think GST should lead to more tax revenue collections for the government going forward.
Well, that point is taken, but so for this financial year, both central government finances, and I think ICRA had put out a report the other day talking about the contraction in capital expenditure at the state level, and they looked at the 12 large states where capital expenditure has contracted quite significantly. Both those put together should be negative for growth this year, right? Unless you see a major pickup in either private consumption or private investment. Given that government spending has been holding up this economy, that should prove to be a negative?
Well, I mean, so there are two issues here. One is, will the general government capital expenditure moderate going forward? And the answer is clearly yes. On the state side, we've seen things like farm loan waiver, which has been offset by capex cuts. And at the central government level, even if you keep GST issues aside, the fact is that the government spent significantly in the initial months of the year. So there's been a front-loaded spending, and there's pressure on fiscal finances. And we've started to see, from August itself, that the government has cut back capex in order to try to get as close as possible to the budget deficit target. So yes, will government, the general government, center state together be less of a growth driver going forward? The answer clearly is yes. But I think, the question is, what does it mean for does it mean that aggregate growth itself is going to moderate? And there, I would say maybe not, because, when the government stepped in was actually the time where private demand was extremely weak because of the disruptions. Globally, we are seeing the export cycle pick up. India is, absolutely not benefiting from that because of our own issues. And if some of these issues are actually resolved, and the economy is getting remonetized, GST disruptions do get resolved going forward. The bank recapitalization has come in. I think private demand can actually pick up going forward. So base case for us would be yes, government does slow down going forward in terms of contribution, but aggregate growth should still be higher.
Would the gross fixed capital formation numbers also start to look better over the course of this fiscal year, partly on base, I guess, if nothing else? Yes, partly on base, but I would say that even if you look at other high frequency indicators, like for instance, production of capital goods, etc., which do tend to be a good proxy of what's going on the investment side, there does seem to be some pickup there. So in the numbers that are coming out today, we would not be surprised if there's a pickup in fixed investment growth. So yes, but the bigger question is,
is this really, the turning point in terms of the big capex cycle? And there, it's perhaps not, because we still need to go through the entire process of, balance sheet deleveraging, capacity utilization needs to pick up. A lot of the boxes need to be ticked before we see a more sustainable capex cycle turnaround, which probably will take another year. But some initial pickup in fixed investment growth is expected today.
Just one last question from me, Sonal. So in terms of what this does for the RBI's decision coming up in a week or so, I think your latest note suggested that you expect them to stay on hold. So unless we get a really weak number, that probably would not change, or your call would not change?
Yeah, I think, the base call is that they're going to stay on hold. It's not just the forward-looking outlook on growth. We have started to see, an increase in oil prices. There are specific food products where prices have started to pick up. Globally, the monetary policy cycle is moving towards more normalization. So in that context, the baseline should be that the RBI stays on hold. Even if the growth numbers do disappoint, I think, fundamentally, a lot of the disappointment on growth which is happening right now seems to be happening because of supply side disruptions, and therefore the solution has to be to try to resolve the issues that exporters or SMEs are facing as soon as possible in order to get growth going.
Hey Sonal, I just have a couple of questions to wrap this up. One is that what are the chances that we might in fact see a number higher than that estimated 6.2%? Most estimates range around 6.1 to 6.3%. And if it were to be that case, that we do see a higher number this evening, what do you think could be the component that would contribute to it? I know I'm being a little speculative here, but there is this buzz building up over the last 24 hours that potentially the number could surprise all of us on the upside.
Right. It's really hard to guess, Menaka. I think, perhaps if I have to take a call, sectors like manufacturing, for instance, could see a much sharper recovery than what most of us are expecting. Or the moderation we are expecting in agriculture may not actually pan out because of some of the non-food items like horticulture, production, etc., being much faster. So it's hard to guess which component really surprises if it does indeed surprise.
It was a speculative question, and the last one is actually a simple one. If we do see growth come in around 6.2 or thereabouts, where does that leave us for Q3 and Q4? Or that's the October to December quarter and the last quarter of the year. And I ask you this because some of the positives that you mentioned, whether it was fixed capital formation or capital good orders or reduction in GST confusion, actually they're still playing out. The problems are still playing out this quarter. So if any, we'll see some cleaning up or relief on that front only in the last quarter of the year. So then where does that put your estimates for the next 2 quarters and then the final year?
Right. So, it's interesting that actually the numbers we've got so far for October have actually been on the weaker side. Like you're saying, the impact of GST on exports was visible. Even in some of the consumer-related sectors, autos, two-wheeler tractors, etc., the numbers have been weaker in October, although that appears to be because of an early onset of the festive season. But again, these are not fundamental, issues. These seem to be more transitory issues, and our expectation is that the numbers we do get going forward for November and December will show a catch-up relative to the weakness we have seen in October. So our expectation for the third quarter is a growth number in between 6.5% to 7% in that range. And for the final quarter, where we also do have positive base effects, we are looking at a number closer to 7.5%. So our full financial year growth forecast is around 6.5%. But I think we are basically, I would say, at the sort of final turning point in terms of the growth cycle. I think we are at the bottom of a cyclical down cycle in India, and there could be delays in terms of how soon we pick up because of these various issues that are going on in terms of the supply disruptions. But I think from a forward looking 6 to 12-month perspective, we are quite convinced that the growth cycle is headed higher in India.
All right, let's hope the numbers prove you and everybody else estimating that right. Thanks very much, Sonal, for joining us this morning on BloombergQuint. Sonal, they're giving you a quick view on what to expect from this evening's very important GDP print.